Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us do now one question where we'll be doing adjustment of overvaluation and undervaluation of liabilities. A and B are partners sharing profits and losses in the ratio of 3:2. Profit sharing ratio is 3/5 and 2/5. Following are the details of their business as per single entry system. Cash in hand, this will be recorded as asset in statement of affairs. Cash at bank, asset. Land and building, asset. Plant and machinery, asset. Stock in trade, asset. Bills receivable, asset. Bills payable, liability. Sundry debtors, asset. Sundry creditors, liabilities. We have opening balances as on 1st April 2011. With this we can prepare opening statement of affairs so that we can find out opening capital. We also have closing balances as on 31st March 2012. With this we can prepare closing statement of affairs to find out closing capital of business. Additional information. Interest on capital is to be allowed at 10%. This is expense for partnership firm. This will be deducted as expense. This 10% will be calculated on opening balances of capital for entire year. Plant and machinery is to be depreciated by 10% per annum and land and building by 5% per annum. Plant and machinery we have amount 2,000. Land and building amount we have 20,000. Both depreciations are expenses need to be subtracted while preparing statement of profit and loss. Creditors are undervalued by rupees 1,000. A creditor is a liability. While recording this liability, creditor, we have undervalued means taken less 1,000 rupees. So here liabilities, creditors are not properly recorded. This will be adjusted in statement of profit and loss. This 1,000 liability creditor which is recorded less, undervalued, we are required to record this as a loss of business because of undervaluation of liability. This will be deducted while preparing statement of profit and loss account. See, this correction of liabilities will result in increase in liability. An increase in liability is a loss or expense for the business. Provide RDD at 5% on debtors. RDD 5% we are required to calculate on closing debtors. Here closing debtors are rupees 4,000. On this we are required to calculate 5%. It comes to 200 rupees. This new RDD will be deducted as expense. A and B brought additional capital in firm rupees 2,000 and 3,000 respectively. Additional capital brought by the proprietor will be deducted while preparing statement of profit and loss. Here the date on which capitals are brought is not given. A and B brought additional capital in firm, rupees 2000 and 3000 respectively. These amounts will be deducted while preparing statement of profit and loss. As dates of introduction of these capitals are not given in the question, so we cannot give interest on these additional capitals. Overvaluation of bills payable rupees 500. Bills payable is another liability. Here they have said overvaluation, means it is taken more by mistake, rupees 500. So correction will finally result in a reduction in liabilities. Reduction in liability is a gain for the business. Therefore, this amount will be added while preparing statement of profit and loss. Prepare statement of profit and loss for the year ended 31st March 2012. We are required to prepare statement of affairs to find out opening and closing capital. For partnership AB, statement of affairs as on 1st April 2011 and 31st March 2012. So this is combined statement of affairs to find out opening as well as closing capital. Let us record assets and liabilities. First, cash in hand, opening 1000, closing 2000. Asset side, cash in hand, opening 1000, closing 2000. Cash at bank, opening 2000, closing 4000. Asset side, cash at bank, opening 2000, closing 4000. Land and building 20,000, opening, closing also 20,000. Asset side, land and building, opening 20,000, closing 20,000. Plant and machinery, opening 2,000, closing 2,000. Plant and machinery, opening 2,000, closing 2,000. Stock in trade, opening 5,000, closing 7,000. Bills receivable asset, opening 1,000, closing 1,500. Bills receivable, opening 1,000, closing 1,500. Bills payable, opening 1,000, closing 2,500. Liability. Liability side, bills payable, opening 1,000, closing 2,500. Sundry debtors, opening 3,000, closing 4,000. Asset side, sundry debtors, opening 3,000, closing 4,000. Sundry creditors, opening 3,000, closing 2,000. Liability side, sundry creditors, opening 3,000, closing 2,000. We have recorded all assets and liabilities. Let us close statement of affairs to find out opening and closing capitals. opening assets total is 34,000. From 34,000, if we deduct these two liabilities, we are getting balancing figure 30,000. This is opening combined capitals of Mr. A and B, combined capital of partnership firm. Closing assets shows total 40,500. Closing assets are 40,500. From this, if we deduct bills payable and creditors, we are getting balancing figure 36,000. This 36,000 is combined closing capital of partnership firm A and B. Thus, we have calculated opening capital as well as closing capital of partnership firm with the help of statement of affairs. Let us proceed to prepare statement of profit and loss. Messrs. AB Partnership, statement of profit or loss for the year ending 31st March 2012. We are required to first start with closing capital of firm as on 31st March 2012. We have calculated closing capital rupees 36,000. To this, we are required to add drawings. In this problem, there is no information about drawings made by partners. From this, we are required to deduct additional capitals brought by partners. A and B brought additional capital in a firm 2,000 and 3,000 respectively. Additional capital brought by partners A 2,000, B 3,000, total 5,000. This will be deducted from 36,000. 36,000 minus 5,000, we got 31,000. From this, we are required to deduct opening capital. We have calculated opening capital, that is rupees 30,000. After deducting opening capital, balance we get 1,000. Profit before adjustment rupees 1,000. To this, we are required to add incomes and gains. Adjustment number 6, overvaluation of bills payable. Overvaluation of liability after adjusting results in reduction of liability, that is gain for the business. Overvaluation of bills payable rupees 500. Liability is overvalued. After correction, it will result in reduction of liability, decrease in liability, which is in turn gain for the business. Therefore, this will be recorded as income. Overvaluation of liability, bills payable 500. If we add that to profit before adjustment 1000 rupees, it is 1500. Less expenses and losses. First adjustment, interest on capital 10%. Here we are required to provide interest on opening capital, as dates of additional capital introduced are not given. Opening combined capital we have 30,000. 10% of 30,000. Interest on capital is 3,000. Next, plant and machinery is to be depreciated by 10% per annum. Plant and machinery, it is 2,000. Opening as well as closing. Depreciation is charged on closing. Depreciation on plant and machinery 2000 multiplied by 10%, it is 200. Land and building by 5%. Land and building opening 20,000, closing 20,000. Depreciation is charged on closing. Depreciation on land and building 20,000 multiplied by 5%, it is rupees 1,000. Creditors are undervalued by rupees 1,000. Creditor is a liability which is taken less by rupees 1,000. After correction, this liability will increase, which is a loss for the business. Undervaluation of liability, creditors, this will be deducted rupees 1,000. Provide RDD 5% on debtors. Closing debtors are 4,000. 5% of this 200. New RDD 5% of 4,000, 200. A and B brought additional capital, already we have recorded. Overvaluation of bills payable, already we have recorded. We have given effect to all adjustments. One thing we are required to note over here, In case of both the liabilities, adjustment number 3, undervaluation of creditors, adjustment number 6, overvaluation of bills payable, actual amount should not be adjusted with closing balance of liabilities. The effect will be given only in statement of profit and loss and not in statement of affairs closing balance. Total expenses and losses 5,400. After adding incomes and gains, we have balance 1,500. From this figure, we are required to deduct expenses and losses. Here we get negative 3,900. This indicates that there is a loss. Loss 3,900 distributed between partners in the ratio of 3:2. A's loss 2,340. B's loss 1,560. In this question, we learn how to give effect to overvalued and undervalued liabilities. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda. Thank you.